G'day listeners and welcome to another APS Weekly News Bulletin, keeping you up to date and well informed on everything happening in the Australian property market in real time. Now today guys, back by popular demand, we've got the big man, the myth, the legend, Big Lukey Chusen. Mate, welcome back to the studio.
Thanks for having me. I actually like the first one of them.
Didn't mind
They're
it?
punchy, bit of information, all at once, done.
Mate, how good. Punchy, nice and succinct. It's beautiful, mate. It's beautiful. Not Jimmy fluffing the lines, dragging it out.
Jimmy
2
and the
hours.
potties, waffle. Punchy, I like it.
Dust from the pockets.
Let's
All
do
right,
it
mate,
again.
Let's do it again. Let's jump straight into it, mate. Story number 1. 1 in 3 borrowers need multiple pre-approvals. Now, article by Annie Kane from the REBs. As reported by REB's sister publication, The Advisor, the latest quarterly home loan report from the franchise brokerage Mortgage Choice has revealed that a lack of affordable housing in the property market is presenting a major hurdle for prospective buyers. As property values continue to rise, with house prices having risen for 18 consecutive months, Lukey, according to CoreLogic, borrowers are finding it harder to find a property and are increasingly needing to take out consecutive pre-approvals to continue the search. The survey by Mortgage Choice found that 62% of respondents had said that their search for an appropriate property was taking much longer than they had anticipated. Moreover, 1 in 3 respondents said they needed to secure multiple pre-approvals because they hadn't found a property before their pre-approval expired, typically 3 months. As such, 82% of buyers said they were making compromises on their buying plans, including buying in a regional area or further out from a city, 60%, buying a smaller house, 50%, buying an apartment instead of a house, Lukey, 35%, or buying a duplex, 23%. The Mortgage Choice Home Loan Report also found that home buyers are needing to borrow more to purchase property amid rising prices. The aggregation found that national average loan size rose 9% year on year to $595,000, increasing for a second consecutive quarter. The Home Loan Report also found that optimism was rising amongst prospective home buyers regardless. As previously reported, around 83% of prospective buyers told Mortgage Choice that they were feeling positive about entering the market, up from 70% last quarter. Waldron says the buyers are recalibrating their perspectives on interest rates and whether there is actually a right time to buy, Lukey. I think this last point is interesting. After hearing a range of predictions on rate movements, from forecasts that rates would fall multiple times in 2024 to speculation that rates may rise and that cuts won't come until 2025, buyers are recognizing that perhaps the right time to buy is simply when they're ready, Mr. Waldron said. What are your thoughts on that, mate? There's a lot there to unpack, but, mate, I think some pretty poignant things there to sort of pick apart.
I think it's something that we see as well, like with our clients
100%.
and across the board, you know. There's no point just rushing into a property just because pre-approval is expiring. Like, I get the time crunch and there's a lot of effort that goes into getting a pre-approval in the first place. And, you know, constraints that happen that may stop people from extending, etc. But there's no point rushing into a property if it's not the right deal for you. So it's something that, especially in a really hot market or a market that is growing or has a lot of pressure on it, you generally see it is quite difficult to secure properties. And we have clients that have, you know, some difficult briefs or may have had a deal fall over because a higher offer came in, etc. So there's so many different variables that we're playing there. So we see it ourselves. So it doesn't surprise me that across the wider market, which is obviously Australia-wide, that we see that on a large scale.
I think one of the other big things there too is it's you know, 1 in 3 have had to go for pre-approval extensions, but I wonder how many have actually just decided once they try and buy for 3 months and they can't actually get a deal. I wonder how many of them even pull the pin and how high that number is of people even not going through and actually transacting, because how hard, for one, how long it's taking, and then for 2, how hard it is to buy. I know that, like, when we're out there on the ground, like, how tight stock is and how hard it is to secure great deals. Man, this is something that we battle literally every single day with a lack of stock. Yeah, man, and it doesn't surprise me at all that you're literally seeing a third of people out there even trying to do it themselves, struggling finding houses in time frame as well. So, man, that's an interesting thing. What about the fact that people, you know, making compromises on that side of things as well?
That doesn't surprise me.
82%, man, 82% of people, 4 out of 5, more than.
That's a lot.
That's
like,
huge,
that's
man.
massive.
82% is massive.
So when you look at it, though, it wouldn't surprise you as well for someone to compromise. I feel like the drop to units, especially in some of those higher price points, would be something that people go, you know, they may have, like, if you're not using a professional or someone to help you, they may have secured or locked it into one suburb, and they may go, oh, I can't get the house I want, or I can't get the 4-bedroom or 3-bedroom that I really want. What else can I get for that same price for 3 or 4 bedrooms? And that's where you'd probably see that drop.
And that's what you're seeing. Like, man, they're either moving out of the city, which is 60%, or buying a smaller house, which is 50%, and then buying an apartment instead of a house, or buying a duplex. Like, there's a huge amount here. It pretty much adds up to almost 100% of people needing to compromise. And they're either moving further out to get the size of house they want, or they're going into a smaller house or apartment duplex.
Well, I feel like if you add all 3 of those together, moving to a smaller house, moving to a unit, unit or moving into a duplex,
not that
that's pretty much all the same thing to a degree. Then it can't get what they want, so they're basically settling for what they can get in that market. And so that's where it's important to not, I think as well, not segregate yourself to one market. You know, there's plenty of good markets out there. And that's why I talk to people about in strategy sessions. You know, we will keep you open to a few different like markets that we're targeting, that we are very confident in. They're all going to perform for you at the same level, but it opens you up to so many more opportunities than pigeonholing yourself into one suburb and one street in one market. It's so hard to do that. And that's where I definitely think a large portion of those extensions would come from.
Yeah, man. No, I agree with you completely. And I think it's an interesting thing to watch as well, because like it's taking a lot longer to transact on a property. There's a lot less property out there. And as they're sort of saying there too, is it's almost like they can't get what they want either. So they either have to spend more or, compromise on what they're trying to buy. And we're even seeing that sometimes from an investment perspective. There's people that we might have invested for years that maybe we always did deals at 300, sub 300, sub 350 grand. And now all of a sudden kind of that same price point now, or that same style of property, even in a new location, might actually be like 450, 500 grand now, even if it's got good value with it. That's where it might be sitting, just because so many of those cheaper price points have just gone through so much growth, and because of the demand and first home buyers, investors, everyone's sort of getting out there and getting into the market as well. So it doesn't surprise me at all. And even like they're saying there, you know, nationally house prices increased 18 consecutive months, which is wild to actually think about. Got that average loan size increasing over that period as well, which is an interesting thing to note when you look at cities like Sydney and Melbourne sort of coming back a bit in the last 12 months. The fact that you're still seeing, I mean, we're still seeing house prices increase. You know, I think it was 8% over the 12 months to July or to June 30. So it probably falls quite in line with that, with a 9% increase. But man, it's an interesting thing to watch, man. I think it's an interesting thing to play out. And exactly like you said there, even we are experiencing this of quite a few of our clients are needing extensions as well, because we don't want to rush a purchase just because we get to the end of a pre-approval period. You want to rush a purchase just to get something done. You want to make sure you're still purchasing the correct asset in the correct location. And a lot of the time, all you need to do is submit some extra pay slips or something like that. And occasionally, there'll come the times where like they don't have that ability to do it, you know, then for whatever reason, whatever circumstances might permit. But for the most part, man, it's not that hard for most people to get the extensions. And I've had to do it myself for a few things too. And man, it's just, it is part of the game right now, and it's just part of playing the game. And sometimes there's going to be times where you don't need to go for an extension, the market's flat, but you're also probably not going to get as much growth. But sometimes you're going to need to go in, do these things, do these style of deals. But we're in that tighter stock environment, tighter market. It's just literally the hand we're dealt at the moment, what we've got to play with.
Yeah, I think as well, I think a lot of that data and those statistics come from, I'd say, for example, let's say you're doing it yourself and you don't have any help. You go out and do all your research. It might take you a month, 2 months, 3 months. You go, perfect, I've got enough funds for that. Then you go get your pre-approval, get your documents, get your pre-approval. And then you got 2 or 3 months after that searching. So it's actually a 9-month process from when you actually probably locked in or started and then locked in that location as where you're going to go. So in that time frame, I definitely think, especially in a hot market, it can move a fair bit. So that's where probably people are settling for something lower or needing to extend to get what they were chasing in the start.
I mean, if they stay in the same location, yes. Otherwise, sometimes they're being pushed out of location a little bit too, having to recalibrate where they're looking to. So, no, that's cool, man. I think it's good to sort of unpack, because I know we've been witnessing it, and realistically, I think this has been in the game for quite a while now of extensions being required. Because of timeframes blowing out and the lack of stock. Like, we've literally been in a stock deficit since late 2020. Massive stock deficit post-COVID, when all that stock got eaten up. A lot of investors cashed out. A lot of people just wanted to get things off the market, take them off the market. A lot of market uncertainty. Whenever there's uncertain times in the market, people don't sell, right? They sit on their hands because they don't know what to do. They don't know whether to sell, whether to hold, or whatever. So a lot of the time they just hold off. And that inaction is actually what a lot of the time creates a pretty big stock deficit. And I think we've been literally reeling from that for the last 4 years. So it's been interesting to watch play out, man. But anyway, wrapping up, 1 in 3 borrowers need multiple pre-approvals. Mate, moving on to topic number 2. What do you got for us?
So, article from CoreLogic. So, is the end of the rental boom in sight? So, article by Tim Lawless, the executive director of research at CoreLogic and friend of the potty.
He told me last week, he was on the potty last week, mate, for the weekly news bulletin for the rate recap. He told me that he should be taking, he said, mate, I think the vote's unanimous, man. I should be taking Lukey Chuson's job.
He can have it.
Can he really?
Yeah, absolutely. He's pretty good on the potty too. I said to you before, he's well spoken, so he knows his stuff.
He's got better jokes as well.
Yeah, he probably does, actually. All right, we'll get into it. So rents flatlined in July and August as rental demand weakens amid slowing migration and affordability constraints forcing a change to household formation. After rocketing 39% higher between August 2020 and June 2024, so over the 4-year period, CoreLogic's National Rental Index has flatlined over the past 2 months, demonstrating a weaker rental market condition since the early phases of the pandemic when rates briefly trended lower. So just to give some context, so they've given it the same period of time prior to the pandemic, so 4 years pre-pandemic, rents only rose by 5.4%. So in the 4 years post COVID, it's risen 8 times faster than the 4 years before COVID. While rental trends are highly seasonal, with rental growth typically slowing through the middle and end of the year, nationally, the annual pace of rental growth peaked at 9.7% over the 12 months ending November 2021, which was a serious high. Despite slowdown in annual rental growth, most cities are still recording an annual rental growth that is well above pre-COVID averages. So slowdown in rental growth is most evident across the unit sector, which doesn't surprise us. Perth and Adelaide continue to show the strongest rental growth with annual gains of 11.6% and 8.4% respectively. However, even these cities are showing a clear slowdown in rental growth, especially Perth, where rents increased by only 0.7% over the past 3 months. So almost 1% up in a quarter, and it's only grown by 1%. So, interesting article. It was quite an interesting read. And I think one of the things that I got most out of there is 8 times faster rental growth in the 4 years after COVID than the 4 years before. So what are your thoughts?
Man, I think it's always an interesting thing to unpack, but I think what's interesting is it's still growing. So, all right, our rate of growth has slowed, but it's still sitting. Like I can't remember what you said. Was Adelaide or Brizzy was the second highest, but Perth was at like 11%. In the last 12 months. Man, 11% 11% rental growth. You got a $500 a week rental. It's just gone to $550 in the last 12 months. I wouldn't be sneezing at a $55 a week rental increase. You know what I mean? To me, that's still great. I think what it shows, man, is like markets always still move through cycles, both from a rental perspective and from a price perspective. So just because we're seeing a bit of a slowdown and the rate of growth isn't at the peak, which we obviously knew was going to come off at some point, it wasn't going to stay at this super frothy level, especially when they started to ease off immigration, right? Because that's obviously puts the biggest pressure on from a rental perspective. But as soon as they started to ease off from that perspective, we're going to see an easing in rental growth. But I think the important thing is that we're still seeing rental growth. And man, it's still coming through. Vacancy rates are still tight. Like in most areas, they're still sub like 1.5%, 1%, which is really, really tight. Sub 1%, you're still growing. Sub 1.5%, you still probably got a little bit of growth every year. And you're renting that property out really quickly to good people, good tenants as well. So man, really positive, I think, from that side. And yeah, man, it's just like a natural sort of transition and progression. And I think like in the next 12 to 24 months, it's going to change. There's going to be other markets that go through rental growth as well. So I just think it's going to be really interesting to kind of watch that play out. And as always, man, like pick the different areas that we think are going to both have price growth and rental growth accordingly for our investors and obviously what they're putting into their portfolios. What are your thoughts?
I think what you said there was key. It's not as if we're seeing rental growth go backwards or people lose rent in capitals. So just to point out specific capital cities. So Sydney grew by 6.4% over the past 12 months. Melbourne was 7%, Brisbane 6%, Adelaide 8.4%, Perth 11.6% was the highest, Hobart 3.7%, Darwin 0.8% and ACT 2.7%. So across the board, you're still seeing a large amount of rental growth over the past 12 months. What they're saying is over the last quarter, it's slowed from that sort of peak that we were seeing, and that's what you said. I like the term frothy rental growth.
Frothy.
Trademark that, absolutely.
That for a beer,
but yeah, I think it's interesting. And when you see markets go through massive amounts of growth, you generally see yields start to taper off a little bit as well. So as people, push into those markets, start paying more, the demand is high, generally yields are a little bit higher, and then you'll see growth and values catch those yields to a degree, and then yields will sort of have their run and grow pretty substantially, and then growth and values will catch it again. So it's pretty cyclical. So it doesn't necessarily surprise me that rents have slowed down a little bit. I think when you said Perth 11.6%, if you go and look at the 4 years pre-COVID, it was 5.6% over 4 years. Yeah. So you've doubled that in 12 months. Yeah. So still really good outcomes, especially in markets that you're keen on, and in terms of the right markets at the right time, you just got to be in the right areas.
Yeah, man, I think it's always this balancing act as well, right? Like if you're buying in the correct market, you're buying the right property in the right location at the right price, man, all those things are going to stack up for you anyway. That like when you're buying in at that pricing, your yield should still be fine. You know what I mean? Like we're not buying in blue chip, back end of a cycle, 15% per annum, average annual growth. That's when your yields are bad and you're very exposed to this because you've bought in at the top of a cycle. That's where you got something to worry about. But when you're buying in at the bottom of a cycle, man, you're buying in affordable areas with decent yields. Mate, it's only blue skies in front of you because you don't really, the markets are affordable, so they don't have that ability to dip, and the rents are affordable as well. So it's the same thing. It's that bottom end of the market, man, there's always a floor under it that keeps it up and allows it to keep moving. And a lot of the time what we see is they actually move the quickest when things start to move because they're from the bottom. They get start to move, man. They get that additional heat because they are the most affordable product in the marketplace. And yeah, man, I think that's only going to continue to play out as we've seen it the last few years. Awesome. Beautiful, man. Well, Lukey Tuster, mate, thank you for jumping on and joining us once again on the Weekly News Bulletin, mate. Any final words?
No, all good. I think that was punchy as we planned, but we'll go again next time.
Punchy as usual, mate. It was all good. It was all good. Listeners, I hope you enjoyed it. If you did, please make sure you send on to someone else who you think might also take some great value from it. If you liked Lukey on the potty, write in. Let us know. Let us know if you want us to get him back on for another APS Weekly News Bulletin. And until next week, guys, that is another wrap for APS Weekly News Bulletin on the Scouting Australia podcast.